as the focus on grade A and grade A plus has become as important as it ever was in the past, what that is doing is helping the players to gain scale. And it's also pushing the grade Bs and grade B plus owners and operators of the world to really push the boundaries and ultimately look at a mechanism for exit. And it could be either a REIT or so on and so forth. So I think that what COVID has probably done is, with the focus on probably three things, I would say, especially for the institutional players, the 30% as Yash refers to, is one, pushing harder on sustainability. Second, ensuring that from a prop tech perspective, a lot of technology initiatives which were probably going slower or in terms of adaptation is now accelerated. And thirdly, the focus on health and well-being and safety, and all of that geared towards achieving two things for the parks. One, of course, is operational efficiencies, but second is also customer experience. So with the focus on all these aspects, I think for the institutional players, it's about taking that next leap and looking for the right investment opportunities, and a lot of them are presenting themselves in a post-pandemic scenario. Having said that, I must admit that the investment opportunities in commercial segment for the institutional players are in two areas, right? One is greenfield development and one is acquiring ready assets. And both continue to have challenges. And as Yash was mentioning, I would say you probably look at, 20, 30 deals before you even sign 2 term sheets, right? The challenge on the development part is, of course, the top micro markets in the top 6 cities are a given, right? That's not a rocket science. And every big institutional players worth their salt would want to get access to the right land. And somehow the pricing impact of the pandemic has been very selective, and for land parcels that are in prime locations haven't really seen that much of an impact. So there is an incredible challenge in that. And even on the ready assets, while there could be quite a few portfolios with discounted values, what you got to ensure as an incoming investor is you price in the necessary asset enhancement you will need to do, because especially they are going to be grade B, and then assign the right value for it. So I think with so much capital chasing the segment for obvious reasons and the right demand drivers, deploying capital is going to remain challenging. So I think while the market will remain very exciting, and I do see a lot of opportunities for further investment and consolidations for investors, but squeezing value is probably as challenging as it was before. I think, Neeraj, when we look at vacancy levels and absorption levels, it is unfair to generalize and talk about the city as a whole. Because really, as Arasdeep was mentioning earlier as well, the city is really made up of the micro markets, and within the micro markets is a type of properties. So if you cull out the top, let's say, 3 micro markets in each of the top 6 cities in India, and within that, also, if you look at all the grade A spaces, the numbers will be very, very different. And I'm quite sure it will be in low single digits. At least that's what we are seeing in all the CapitaLand parks, and I'm sure with few of the other investors' parks as well. So we must be very careful when we are looking at vacancy levels and broad brushing at the city level. I think that data is a bit meaningless, because it's really down to which micro markets we are talking about. To the question of what's going to happen over the next 2 quarters, the trend that we are seeing, and after a lot of conversations with some of our largest customers as well, is that with the vaccination now really entering a stage where, let's say, in the next 2 months or so, the second doses should be completed for a majority of the population. The impact post the second wave is a very different story than when we were up to post first wave, which was, let's say, October, November, December last year, right? And what that is resulting in is a lot of conversations already about starting to return to office September, October onwards, and depending on the companies, stretching out to the Q1 of next year. What we are seeing really is also conversations starting to happen a lot on new RFPs and new leases. If I just see the number of site visits and the number of RFP responses in the last 3 to 4 weeks, has been much more than what we had seen in the last 3 months or so. And we are also not really seeing any relinquishing of space in any significant quantities from any of the existing customers at this stage. Whatever rationalization had to be done probably happened to a certain extent over the last year or so. So I would say I don't know where the net absorption numbers would really land, but I honestly don't think most of the large owners of parks are really too keenly watching that number, because they really know pretty much the next 6 months, their lease profiles, their expiry profiles, which customer is going to stay and which is not. The question really be about how is the slope of the pickup curve early next year. And I think if hopefully COVID remains fairly under control, even if there is a third wave, but the amount of medical tragedies are not so much because of vaccination, then I think the pickup early next year will be very strong. And that's really what most of the investors, I guess, will be focusing on, because this year, half of it is gone. The second half of the year, maybe, slightly more than double of what we slightly similar to what we saw in the first 6 months, or maybe even more. But the real focus will be the recovery next year. And for all the reasons mentioned by some of my other panelists earlier, we are quite bullish. And Vinod was mentioning in the earlier session as well on the drivers of why this pickup will be very, very strong. So I guess that's where we all are really looking forward to. Very interesting, Neeraj. I'll keep it short in the interest of time. Just last week, we made 2 huge announcements in both these sectors, where we closed our second logistics fund and made our first acquisition in data center in Mumbai as well. I think logistics boom had already started probably 3 years ago for all the right reasons, and the pandemic has already pushed it with e-commerce really taking the lead, right? So I would continue to expect more and more investment being poured into the warehousing sector. The penetration of grade A warehousing in India is nowhere close to what's in China and the US. So if you just purely look at the numbers of grade A warehousing per capita, we are probably 1% and 0.1% of these 2 geographies. So there is a huge potential, and that's the reason we, along with many of the other institutional investors, will continue to pour a lot of money. I would reiterate that investors would need to be optimistically cautious, because the rents haven't moved as fast as they have continued to move in office over the last few years. So while right now it is a volume game, scale game, whoever gets hold of the right land parcels and builds up the huge portfolio, because there aren't many players doing that. So it is that race right now with many coming in. I do foresee in the long run, probably the top 3 to 4 will really hold key of the market. But the most critical part for me for logistics will be entering the land at the right value, because the whole model is super sensitive to land price, because the rentals are very low as against an office where you're talking $1 per square feet. Warehousing is 20-25 rupees per square feet, right? So I think that will remain very, very critical. And data centers, again, for all the policy changes, data localization, and the entire digital transformation being pushed through globally, and India getting a lion's shares of that. I think, again, huge potential on data center. I won't delve into how big the market is going to be. I think that's for all to see, and we can see the amount of investments. The one thing that I would highlight, just like I did on the land price side, on logistics, on the data center side, I think the key thing to watch out will be how much of that investment and operations can be sourced from green power, because data centers are huge energy guzzlers. For us, CapitaLand, while data center is a huge investment opportunity globally, we're very cognizant that our objective is to run as many of them as possible purely on green power, because only then it matches with our sustainability targets, which are also very ambitious. But if you're not thinking about green power right from now when you're investing in data centers, I think if you want to be a firm focused on ESG, as Khair mentioned, then you're going to run into trouble. But I think if we can take care of that, then huge potential for both the sectors.